So today we're going to cover the computations and concepts overriding those computations for debt, long-term liabilities. Excuse me, in this area of expertise, we have bonds, and there's a $1 trillion bond market. We have troubled debt. Troubled debt is the overriding caption for settlement of debt, extinguishment of terms, or restructuring or modification of terms, those two different aspects. And then the last part is somewhat recently been tested on FAR. It involves the three classifications of debt securities when purchased as an investment by either individuals or corporations investing in corporate debt. So we'll start with the bond workbook. These are all the workbooks for FAR regarding long-term liabilities and some questions that I also add for you to go through. What we want to do initially is look at the concept of bonds, because oftentimes we find that it's much undertaught in college. The students come away really not understanding the complexities of bonds. So we want to go through first and give a background. We want to understand how this market works to some degree and how the interest rate is pegged by the credit market. Everyone knows we have a couple of different rating agencies like Moody's, Fitch, S&P, all rating bonds. We also know that interest rates affect the price of the bond, but we want to look at this in more depth and detail because in accounting, we have, excuse me, we have to understand present value. We have to be exceptionally good at it. It's used all throughout accounting and finance, and it's important to understand it thoroughly. So we have a theoretical situation where a company, marina company, wants to issue or sell $1 million in long-term bonds. The bonds will mature in 10 years and have a stated interest contractual coupon rate of 8% and an effective yield to maturity or market rate, all those meaning the same thing as well, of 10%. When the bond issuer comes into the market, the party looking to borrow money, the market assesses risks. Some of those risks are systemic, and some of them have to do unsystemically or non-systemically with the company itself. Expected future inflation is a global issue, systemic issue. Interest rate risk, also a systemic issue. And then we have default risk, which would be an assessment of marina companies' ability to pay, the taxability of the issuance. Sometimes there's favorable industries or markets that taxes favors, and then a lack of liquidity. How long do I have to tie my money up if I want to hold it to maturity? So as this example shows, Marina went to the market with a coupon rate of 8%. That is the rate that's stated on the bond. The bond itself is a legal instrument. In other words, whatever's stated on that legal instrument must be followed by the bond issuer. So they must pay 8% interest on $1 million, $80,000 interest every year. However, the market says, well, you know what, Marina? Because of future inflation and interest rate risk ticking up, the market wants 10% on your bonds. Therefore, we will lend you the money. However, you are going to receive $877,109 for the face value of $1 million to be paid 10 years from now at maturity. There's a discount, and we call it a discount because he's not receiving his face value. He's receiving $877,109, and the discount is $122,891. So what we want to show and what we want to understand is, number one, how to value a bond, and number two, we need to understand the nature of a discount or a premium. And what we're going to prove through further tabs in this session is that 122,891, the discount represents additional interest. As a matter of fact, it represents 2% more interest, raising this bond from an 8% to what the market wants, 10%. And 122,891 withheld up front is additional interest Marina paid, and it's exactly 2% on an annuitized basis. So we want to go in and understand that and make sure that we know how to calculate it. At first, we're going to go through it longhand so that we're familiar with how that's done. And then I'm going to give you a very quick way for the exam so you can calculate a discount or a premium um, under 10 seconds. All right. So here is the present value of an annuity on this bond. What we need to figure out is what's the present value of two payments, two forms of payment. One, the $1 million face value, which will be paid at the end of 10 years. And two, the $80,000 in interest, which will be paid as an annuity stream, a constant equal amount year after year, $80,000. So a lot of students are algebraically good. This is the formula for this. If you are, then you don't need to worry about practicing this three-step formula that I developed. But if this is something that would cause concern, in other words, if I did this formula, I might, and I would, make errors in my bracketing or how I developed the structure of the formula. So what I said was, I need to teach my students and myself a quick way to do this. Here's what we say, and it further describes what the bond and how the bond is valued. We know the market wants 10%, and all calculations from this point on are done at the market rate because the market controls and they're dictating how much cash they'll give you if you want to go ahead with the bond. We take 1 divided by 1.1. That 1 is put there to allow the calculation to go forward and has no effect on the value. And this is 10% to the 10th power. So what we're saying here is bring back $1 from 10 years from now at 10%, discounted 1 divided by 1.1 to the 10th power. It has a principal value of 38.5 cents. So to understand bonds, we need to think about it. What we're saying here is that if I were to borrow from you money today and said, I will pay you $1 10 years from now, and you can earn 10% interest, you would give me 38.5 cents today. 38.5 is the present value of that financial arrangement. And at the end of 10 years, if I hand you $1, you will have made 10% per year. That's the essence of the bond principle. Since we have 1 million of them, the bond principal is worth $385,543. That's the first payment. The second payment is the annuitized stream of $80,000 a year that we're compelled by law to pay as interest. We need to present value that stream of payments. So we look at the present value of $1 at 38.5 cents, and we say, well, if that is what the dollar was eroded to by the time value of money, 10%, 10 years, how much interest was removed from that dollar? 61 cents, because of course they will add to $1. So we know if the dollar is worth 38.5 cents at present value, 10 years, 10%, the interest that was removed from that dollar is 61 cents. Once we have the interest, all we need to do is divide that interest by the rate that we're calculating, the market rate, 10%. When we do that, it will give us the annuity factor. Once we have the annuity factor, then all we need to do is multiply it by the payment that's going to be made on an annual basis for 10 years. That will give us the present value of the future payments 10 years in a row, $80,000 a year. To be certain, they will be paying $800,000 nominally. However, the present value of that stream is 491,565. When we add the principal and the annuity stream together at present value, it gives us the total value of that bond at the market rate, 877,109. The next thing we do is we need to prove this. We need to have a schedule from which they will ask many questions on the CPA exam about how to value the bond, its carry value at any point in time. Also, what's the true interest expense and the cash paid, as well as tying it all together and showing how this withholding of 122,891, the discount, can be shown to be an increase in the interest expense over 8%, pulling it up to a 10% rate. So now we continue on, and we're going to get into the calculation of that in the amortization schedule. This is very important. This is what they ask questions from when you're on the exam. This is a very important area. They always fashion the questions based upon the amortization schedule, interest, carry value, amortization of the interest for every certain year.